In today's session, we look at another standard, non-current assets held for sale and discontinued operations, IFRS 5. This standard covers measurements, presentation and disclosure of non-current assets and disposal groups of an entity, and also the presentation and disclosure of discontinued operations. The standard applies to all of an entity's recognized non-current assets and disposal groups, with the following exceptions. Do not ignore these exceptions. The examiner has in the past picked from the exceptions and tested or applied this standard, and instead of just saying that this standard does not apply to these areas, students have gone to a great length of explaining and doing calculations which do not earn them not even a single mark. So you need to know those which are an exception from IFRS 5. These are deferred tax assets, assets arising from employee benefits, financial assets within the scope of IFRS 9, investment properties accounted for under the fair value model, biological assets measured at fair value, and finally rights under insurance contracts. Take note of those exceptions. The standard defines a disposal group as a group of assets to be disposed of by sale or otherwise, together with a group in a single transaction and liabilities directly associated with those assets that will be transferred in the transaction. The standard classifies non-current assets held for sale or disposal groups as those assets which an entity whose carrying amount will be recovered principally through a sales transaction rather than through continuing use. For an asset to qualify under this standard, management should be intending to sell the asset, not abandoning the asset, not giving it away, but principally through a sale. For an asset to be classified as held for sale, it has to meet certain criteria. There are two main criteria to be met. All the two criteria should be met, but the second criteria has got 5 sub-criteria, and all the 5 sub-criteria should also be met. So the first criteria is the asset or disposal group must be available for immediate sale in its present condition, subject only to usual and customary sales terms. Meaning, this asset should be sold in its current form. The examiner has in the past brought a question where management decided to sell an asset, but selling it in the present form would fetch a lesser amount, but painting that asset would increase the value of how much they would sell it at, so they decided to paint it and classified it as non-current asset held for sale. That asset did not qualify, so it must be in its present condition without any adjustments, any improvements made to it. The second criteria is that the sale must be highly probable. Under this criteria, we have 5 other sub-conditions. So for a sale to be highly probable, the first condition is that the price at which the asset or disposal group is actively marketed for sale must be reasonable in relation to its current fair value. So the examiner may bring a question where they give you numbers for you to compute the fair value, then they also give you how much they are pegging the asset on. If the fair value is higher than, if the sales value is higher than the market value, then that is not a reasonable value. So it means that condition is not met. And remember, all 5 conditions have to be met. For the sale to be highly probable, also it is unlikely that significant changes will be made to the plan or the plan withdrawn. So once it's been decided to sell the asset, there should be no indications that the plan to sell will be withdrawn or there will be changes made to the plan. The third criteria is that management at the appropriate level must be committed to a plan to sell this asset. The fourth one, there must be an active program to locate a buyer and complete the plan. And complete the sale, and the plan must have been initiated. The fifth condition is that the sale is expected to be completed within 1 year. Now there's a catch to the last condition. You cannot force customers to come and buy your assets. But the fact that the asset has not been sold within a year, it should be because no buyer has come forward. It should not be because of management's doing. Either management is dragging its feet or dilly-dallying because they want a better price. So all those, the two conditions plus the 5 sub-conditions for the second one, must all be met for an asset to qualify under IFRS 5. We move to the measurement. So once the asset has qualified, it has met those conditions, how do you measure it? Immediately before initial classification as held for sale, the asset or disposal group is measured in accordance with the applicable IFRS. So for example, if the asset that you are selling is a PPE which falls under IAS 16, the asset needs to be revalued as per IAS 16 conditions. That is immediately before initial classification as held for sale. On classification as held for sale, the asset is written down to fair value less cost to sell if this is less than its carrying amount. So any impairment losses arising under IFRS 5 is recognized in profit or loss, and the credit allocated to assets of a disposal group using the IAS 36 rules, which are first to goodwill, then to other assets on a pro rata basis on carrying amount. It's important to know these stages. Each time the examiner has brought a question which includes calculations under this standard, this is where the calculations have centered from. You need to know those steps. The first step, which is the initial classification. Basically there, you are testing for impairment. On classification, you write down the fair value, you write down the asset to fair value. That is if the fair value is less than its carrying amount. You remember that an asset is carried at what? Cost minus depreciation equals carrying amount. So you'll be comparing the carrying amount and the fair value less cost to sales. Once the asset has been written down, it is then declassified from non-current assets. It's moved under the current assets. Then you stop depreciating the assets. If it's a tangible asset, if it's an intangible asset, you do not amortize it either. Once the asset is now held as non-current asset held for sale, any subsequent changes in the fair value less cost to sell are recognized as a further impairment loss or reversal of an impairment loss. However, Any gains recognized cannot exceed cumulative impairment losses to date, whether under IAS 36 or IFRS 5. How do you disclose these non-current assets held for sale? You disclose as a single amount of assets and liabilities. You disclose on the face of the statement of financial position. You disclose them separately from other assets and liabilities, and normally you bring them under current assets and current liabilities. You do not offset the current assets and the current liabilities. Each one will come under the different caption, no offsetting at all. You have to review whether these assets should continue being under non-current assets every year in case they've not been sold, and if they are still meeting the conditions to be classified as non-current assets held for sale. If they no longer meet the conditions, then any non-current asset that ceases to be classified as held for sale, or it ceases to be included in the disposal group classifications as held for sale, it will be measured at the lower of its carrying amount before the asset or disposal group was classified as held for sale, adjusted for any depreciation or amortization or revaluation that would have been recognized had the asset or disposal group not been classified as held for sale. So what are we saying there? Remember, when you classify the assets as non-current assets held for sale, you move them from the current non-current asset section, you take them to the current asset, and you do not depreciate them anymore. So when you reclassify them back to non-current asset, that depreciation or amortization which you had not charged the time the asset or asset disposal group was classified as non-current asset, you need to backdate it and charge all that depreciation or amortization. Okay, so it will be carried at the lower of the carrying amount and its recoverable amount at the subsequent date when the decision has been made not to sell it anymore. So you compare the two, the lower is what you get, and declassify it from, or you reclassify it from current assets back to non-current assets. So we'll continue the session in the next video.